Hey everyone, we're going to go ahead and start the tokenization and token stock. If you're here for the application of blockchain transfer pricing, you're in the wrong room. Head upstairs for that. Moderating this panel today will be Mr. Subhankar Sinha, the Director of FinTech Practice at PwC. Mr. Sinha leads PwC's efforts around application of emerging technologies on business and operating model innovation. He has been working with his clients to build blockchain-based proof of concepts and evaluate security and privacy of blockchain applications. Including our panelists today are Felix, partner at Coinfund. Mr. Felix leads investment research and advises clients on product, blockchain-based business models, token economics, and crouch sales structuring. He has 10 years of private equity and leveraged finance experience. Following up will be Ryan Zurrer, principal and venture partner at Polychain Capital. Mr. Zurrer leads private investments and helps projects structure their token offerings. He has been an active angel investor in the blockchain ecosystem since 2012, backed both startups and token-enabled networks. Jeremy Millar is the chief staff at ConsenSys and advisor to Gnosis. Mr. Millar oversees many of the enterprise activities and strategic initiatives at ConsenSys. He is also an active angel investor and mentor with the Barclays Accelerator powered by Techstars. Finally, we have Mr. Brian Kelly, founder of BKCM. Mr. Kelly is an investor, author, and financial markets commentator. He is an expert in global financial markets, macroeconomics, and digital currencies, and the author of the book, The Bitcoin Big Bang, How Alternative Currencies Are About to Change the World. So let's listen in how alternative currencies are about to change the world.
Thanks, Sunny. My name is Subhankar, and welcome everyone to Token and Token Launches. Looks like this is a full house, so there's a lot of interest and there's a lot of hype and wealth being generated. So let's start with Brian explaining to us what is token and how it's being used and what's going on in the token economy.
Thank you. Yeah, so a lot to talk about, lots to live up to if I have to explain, if I have to say that how tokens are going to change the world. So if you guys got about 2-3 hours, it's fine, we're okay. But in a short period of what's going on with the token, what is a token, how is it working, how are companies using it, or how are organizations using it? Essentially, what you can do with any of these blockchains, particularly Ethereum, you can create your own token. You can call it the BK coin. And then the BK coin then represents some kind of organization behind it. And what's happening now is people are selling those tokens. You monetize the whole thing. Let's say it's called free mining. And so you have all of the shares of the coins available to you immediately. And then you sell those coins to the general public, usually in a token sale. I think we're calling them token generation events now is the proper term. And so then the money comes into the organization. Generally speaking, the organization is not a corporation. It is usually just a group of individuals working on an open source project. And so what's that creating? It's creating disruption in the capital markets. And it's one of our themes when we invest is that you have disruption of venture capital by this, because what's happening is startups are bypassing venture capitalists completely and are able to raise hundreds of millions of dollars recently. With these tokens. And then if you look a little further down the road, it has the potential to disrupt investment banking. Because if you think about these companies are essentially going public from day one. So what's the role of an investment banker in year 5 or 10 of their life cycle when typically maybe a company would go public or need some secondary financing? Generally speaking, these companies or organizations will have a big war chest and or they've retained some of the tokens for their use to sell 5 years from now. So you may not need an investment banker. So that's kind of the general landscape. It's on fire right now. There's probably some kind of bubble or bubbleette going on in it. And so, there are some very good projects out there. And then there are some ones that are raising an awful lot of money, and we'll see if they can play it.
To add to that?
I would just make one point that you don't have to sell tokens. In fact, just yesterday, an extremely innovative startup released a token called Moderator. The startup is called Millar, where you can't buy the tokens. You have to earn them through proof of intelligence on it's actually proof of intelligence because it's an artificial intelligence platform, and you can only earn them. And so while it's very popular and obviously quite lucrative in the current moment to sell tokens in these token crowd funds that people are calling ICOs, there are many models that will pop up over time that will not be just selling. They'll be earning them and driving network effects on open and decentralized networks.
It's a very good point, Ryan, because one of the things we like to think about is how you're taking a cash flow business model that maybe extracts rent, and then you create a token, and the token becomes a community-owned asset, and that asset is used, it's widely distributed, and everyone holds a piece of it, and then it can become tradable on the secondary market. So you sort of actually can build value versus what you would normally need to just extract value from. So that sort of, you don't need to do a token sale. You can do a token sale, and that sort of kickstarts the value of a token. But if you make your project very desirable, and you make people kind of clamor to work their way to earn your token, like Millar is doing, then it can eventually sort of find value, and you can monetize your sort of your pre-allocation down the road. So you may not need to do a Series B, Series C if you held some tokens in a foundation. You could actually do sort of secondary fundings or just continuous token sales to keep your venture funded.
So I'm going to challenge the assertion that investment banks will go away. As a former investment banker, I think they will change. But I think right now there is clearly a lot of capital available. But on the other hand, the supply of projects is limited, and that dynamic will change over time. And the process of due diligence, reviewing business models, challenging the capabilities of the team, understanding the key distribution models, understanding where the pools of capital exist, are capabilities that people will need access to. Today, it's relatively simple. There is more demand than supply, but that is not necessarily something that will continue. And assuming that the current trend of the inflows of fiat, more traditional capital comes into this space, into the cryptocurrencies themselves, then I think increasingly we are going to need to see services that meet more of traditional investor requirements.
Yeah, I would agree with that. I mean, it suggests that investment banks would go away, but they're going to have to adapt the ones that survive, right? This is a new I hate to use this word, but it is a new paradigm, right? There is something different going on here that is disrupting the traditional business model. So if you're an investment bank, you have to think, okay, what are our core competencies? Our core competencies are dealing with clients, showing them the good deals, advising on the deals, a lot of stuff that you're doing, Alex. So that's kind of what'll have to happen, and they'll have to get up to speed on this new technology.
So staying on this theme, Alex, you mentioned about different kinds of token structures. So I'll start with Ryan. Explain to us what are the different kinds of token structures, like application layer, protocol layer, and what are the business cases, and from a regulatory compliance perspective, how should actually an investor or an issuer think about the token structure?
So there's a lot to unpack there, and the taxonomy of tokens or the family tree kind of separates, as you mentioned, the protocol layer and application layer, and then in the application layer you've got all kinds of different use cases that will pop up, and we're actually more excited about the use cases that no one's even thought of yet, and there will continue to be a lot of innovation there, and you can go through many different things like cloud computing and gaming, and finance and investing platforms and various different things. Then at the protocol layer, which is sort of where we're more focused and where our interest lies, often there are platforms to allow kind of an arbitrary level of applications to be built on top. With respect to tokens specifically, we're seeing a lot of different structures and different mechanisms being used. You see governance being tested and rolled out very slowly. No everybody's got governance right yet, and those who sort of approximated the right type of governance have lots of checks and balances in that system. Then you've got more transactional layer tokens where it's used to buy resources on a network like file storage or computation, and again, just a lot of innovation happening around the space. But something that I'm seeing an emerging trend with today is what I call keepers. And keepers are a utility layer of workers that kind of work and add value to a certain network. So in Maker, it's arbitrage traders. In Augur, it's people who confirm events. In one protocol, it's people who perform mining for capitalists. And this keeper layer, this sort of utility layer, is probably the best suited to be remunerated in the native token, because the native token is naturally more volatile. And they're also probably the best suited to have very significant input in governance. And that's because they work on the platform. They're most concerned about the nature of the development of this platform. And so we're seeing a lot of innovation happen around how do you properly incentivize this keeper layer and keep checks and balances in this keeper layer. So you need to have multiple keeper layers at times, but in general, we like seeing that network effects being driven by utility actors that work on the network.
Sure. So, I think I generally agree with that comment. I guess part of the challenge today, when we look at these models, is very few of them are actually operational at scale, right? And so we've got this situation where there's a lot of capital available to build something, and not a hell of a lot built yet, right? So a lot of the insights that we're trying to pull from, we're pulling from a relatively limited knowledge base, right? So we're trying to make these taxonomies out of sort of bottom-up analysis and what's worked in the past. But and clearly, as pointed out, where the network effects and incentivization is most obvious, there are clearer paths for how it works. But this is still early days for all of us.
Yeah, I think, to add to that a little bit, there's extremely vast design space within what you can do with tokens. As Ryan was mentioning, you can make them access tokens, you can make them profit tokens, you can make them, all sorts of forms of utility governance tokens. And simply the reason so many tokens exist, and this is kind of a debate amongst people who might be, Ethereum people and people who might be Bitcoin people, are that, you can't own a US dollar and then have governance of Google stock, for instance. So each token, needs governance to some degree when it becomes fully decentralized, and that's sort of a key challenge that's going on today, where you can sort of copy data. Blockchain is, many copies of the same data string, but you really can't copy people's time. So to have thousands of people voting on the same topic, may be extremely inefficient, and there's no way to, and so that's a very active, space of research, is how do you properly govern these systems in a completely decentralized manner. And then, on the incentive piece, there's almost so much design space that there's a study of crypto economics that's going on, and it's how all these incentives work for all the, the people within your network, and the more deeply integrated the token, is, other than just a transactional service, the better, the longevity of that system may be. But like one instance would actually be Bitcoin, where you have users who use Bitcoin for transactions, but then you have miners who maybe aren't necessarily incentivized to provide the best service for those users. And you're seeing that in the block size debate, where by keeping blocks small, they actually earn more fees. So the fee pool is bigger by clogging the network. So you actually have a bit of yes, they both want the network to succeed, but they're still not sort of aligned on creating the best user experience.
Yeah, I would just, Alex touched on something interesting. How do you govern these networks? And, from a very high level, the way I look at it is, if you think of Bitcoin as a new global currency for commerce that is not yet widely distributed, but it's going to become widely distributed, then you start to say, okay, you're using this for global commerce. So let's say I'm in Romania and I'm paying somebody in Argentina. If I make that payment, what rules govern that? Is it Romanian law? Is it some kind of international law? And that's where the governance layer of these tokens comes in. And if you think about that ecosystem as a whole, as this new kind of global commerce ecosystem, what else do you need to make this work? You need a legal system. Well, perhaps that's where Ethereum comes in with smart contracts. That becomes your global legal system. And then what else do you need? So when we talk about protocol layers, like Ryan was talking about, to me, what a protocol is what is that base layer that you need to run this global ecosystem? And we're starting to find those out: governance, legal, payments. There's probably a couple others that I haven't thought of right now. But that's how I look at it. And I think it's one way to kind of think about this, if indeed we are really building out this decentralized web, and that is where we're going, which is kind of the moonshot investment base case for this, right? If we have a decentralized web, all these protocols are not going to be worth billions of dollars. They're going to be worth trillions of dollars.
Yeah. So there's probably one structure that we can agree that doesn't make sense in just about any context, and that is a rent-seeking token that just extracts value from the network. And so we immediately look away when projects come to us, and essentially a token represents the expectation of profit from work on that network to early investors. And we look away for two reasons. One, that's going to be a drag on network effects. And two, that's also going to approximate a security in a much higher likelihood. Because, again, the expectation of profits from the work of others obviously fails the Howey test. And so anytime we see a rent-seeking token, that's probably not something that's really interesting.
So I agree with the point. I think tokens that are securities in certain instances are a viable model if you're clear that what you're doing is selling a security. Right? And I think for the token ecosystem, certainly there are more innovative and deeply integrated approaches, but there are circumstances in which tokens that are securities and conform to the regulation, like what Brock did with his raise, right, are appropriate. Now, I can totally understand.
It could be appropriate without being that interesting, right?
Yeah, correct. Yeah, absolutely. You can model traditional structures on blockchain if you want, and there are clear rules of how to do that.
And that's perfectly fine. It's just, again, what gets us excited about this space is the potential to accelerate, and what is exciting for me about tokens is tokens accelerate network effects. In fact, they act like rocket fuel on network effects. I mean, look at even the early example of Bitcoin with just hashing power, right? You've seen just a literally absurd amount of computational resources now dedicated to securing this network, so much so that I've been told by university professors that it represents 120 times the computational power of Google, and more than the 10,000 largest banks globally is the computational hashing power of the Bitcoin network. So tokens can drive network effects, like something we've never seen. Securities could be interesting, or it could be perfectly fine, and you can do that. It's not what the thesis is here.
Okay, but the flip side of that coin is no.
So I think audience probably don't know. I don't know how many people actually know what are the different types of tokens. Securities, software sale, and so on and so forth. So can one of you guys who would explain the basics of different types of token being? So because we're talking about securities, we're talking about software sales, rent-seeking token, and so on and so forth. I think the definition has to happen. So
I mean, we can just make a really quick distinction, right? There's going to be all sorts of digital assets out there, and they may be tokens, they may just be other forms of digital assets. But kind of what we're focusing in on here is actual, decentralized network tokens that use incentives to grow extremely large, user bases, as well as people that contribute to those networks, and to capitalize on that flywheel effect, which actually gives it a greater chance of succeeding. So I think the distinction that Ryan is making is, between, let's say you take a piece of real estate and you conform to the existing legal structure, create equity rights behind it, and then tokenize it. That's totally viable. And if you actually look at a lot of the research reports, that's going to be probably 10 times the size of our decentralized network market going forward. But I think all Ryan's saying is that he's making a distinction that the VC side of the space is sort of in the actual networks themselves.
Absolutely, I agree from an interest perspective. But let me ask Ryan, how many of the business plans do you see are people trying to develop utility tokens so that they're not securities versus deep thinking around the creation of the network effects?
Well, we're in a pretty good spot where we actually are in front of a lot of really talented entrepreneurs every day that are thinking really deeply about network effects and how to drive network effects and create a token that creates an open source network. And that's really what our focus is. And most startups understand that's what our focus is. So if they have a rent-seeking token, or if it's sort of like a not that compelling of a network, we often we're not the first choice to go to for help and for funding.
So I would just say the distinction I make between kind of two classes of tokens, whether it's a security or whether or not it's a network token, is pretty simply is, do I need the token to operate the network? So if I look at Bitcoin, without the token, there's no economic incentive for the network to operate, right? The miners don't get paid, therefore transactions don't get validated. So when I look at any of these tokens, I say, do I need that token to work on the network? And you think about Google stock. I don't need Google stock to do a Google search. So if I look at a token and say, I don't really need this token to make what's happening, then to me, that's a security. At least it looks that way. It may not be legally a security, but that's how I kind of draw the distinction between the two.
The other thing about rent-seeking, a rent-seeking business model using a token is that in an open source environment, these networks are copyable. So if you try to create a business model around trying to take a 1% fee of every transaction that goes on in your network, and someone may just copy it and remove that fee.
I mean, Zcash being the ultimate example of that.
Fascinating conversation. Segue from that is recently we saw Status raise like 270 million. Bancor raised 153, and there are other examples in a matter of a few hours. And taking a page from your Maker versus Keeper.
Keepers act on Maker.
Yes.
Keepers are part of the Maker network.
So what are the different kinds of business models that issuer can actually think of to drive? And it's from an investor perspective as well, because there are a lot of people in this particular room might be interested in buying tokens and taking a position. And we're probably not going to get into valuation, but at least from a business model perspective, I think you should try to explain different business models which you're seeing in the marketplace for these different kinds of raises. So, Jeremy, you would start.
So can I just comment that token raises, although they complete very quickly, tend to not actually happen in 3 hours or 1 hour or 6 minutes. There is effectively a pre-launch book build that happens, right? Where the creators of these networks go out, talk at conferences for months, find the, quote, the ether whales, go out for dinner with them, buy them drinks, right? So it's slightly a misnomer to say that, well, they raised X amount of capital in Y number of minutes. Because really, the Y number of minutes for the X capital is the actual crossing of the auction, right? And every day on the New York Stock Exchange for 5 minutes, the opening prices are done in a pre-open cross, right? Auctions can happen really quickly. And this goes back to the point of the investment banks are being disrupted. Well, right now, it's sort of people are playing their own investment banker, right? And they're designing their own token, and they're going out, and they're finding out where the big crypto deposits are, and they're spending time with those people. But it's a bit of a misnomer to say the capital was raised in 5 minutes or 5 hours, because it wasn't. It was raised over a period of months.
So fair point, but still go back to the business model question. Brian, do you want to start?
So it depends on which side of the token you are and what you want to do with your business, right? If you want to get rich quick, I can tell you how you do it. You write a 30-page white paper, you issue a token, and you sell it out, and then you probably have to move out of the U.S., but put that, knock yourself out. So that's one business model, not one that I recommend, but you can do it. The other business models are probably not any different just because you're issuing a token doesn't necessarily mean that this is a new business, right? The business models still have a function in this space. So a couple different things. If you are the business model that I like best in this space, is you have an open source token that is needed to operate the network. And that is, anybody can use it, it's not for profit, there's a foundation behind it, that their whole goal in the foundation is to support the token in whatever way they need to do that. Secondarily, you have a for-profit corporation that is building projects on top of this platform. And to me, that's the best model out there at this point in time. And those for-profit organizations and the foundations both need, in my view, a traditional business plan.
Yeah, I might add a little bit of an extension to that. Why this tokens can be so interesting is, those business models can be actual extensions of your business too, where you form a sort of collaboration. So what that might look like is, a deal we recently worked on for Kick Interactive is, they have this huge group of customers or users and no way to monetize their messaging application. And when you can't monetize, but you have a really valuable resource, it's really good to say, okay, let's create this asset where our users actually own it. We're going to stop trying to monetize with advertising, and we're actually going to let our users build an economy on top of it by open sourcing our network. And when developers come in, they start earning, users start buying their services, and you just hold a chunk of that asset. But also, an extension of that is you say, we created this whole foundation to control the supply of a large chunk of this asset, and anyone can join in on this network. So competitors can come and say, I'd like to integrate with this crypto token as well, and you create an actual rewards engine where everyone who's part of this ecosystem can earn proportionally to the value they're bringing. Maybe it's based on number of transactions or value of transactions from this big piece of the asset. So then all of a sudden you went from one company to an ecosystem of companies, and everyone can actually sort of shift to a new monetization model. So that's another.
Yeah. And that's really compelling, right? Because in the sort of prior Web 2 generation, a 30-person company was acquired for $18 million, whatever the WhatsApp algorithm is, right? Or the other example that people sometimes talk about is Uber, where it's one of the guys from USV has this great line about how it was the riders and the drivers that created all the value, and yet it's all the profit of it is centralized, right? And so this idea that the value of the software is proportionate to how it is utilized by the users. So how do we have the users take a greater role? And we live in an environment where everyone has a supercomputer in their pocket. People are becoming more technically savvy, and we have a compute model now that's much more decentralized, and programming methodologies and system structures that make it much easier for the users to be involved in the development of the system.
And just really quickly, I think people seriously underestimate the cooperative or community-owned business model because it's just not talked about, right? I mean, there's stores out there like REI who do extremely well, but the financials aren't public. There's just many. There's every co-op building in New York City. leverages shared resources, gives sort of tax credits back to everyone who lives there. Everyone pitches in to make the community better. So there's all these community network effects you can create that we're all living around, but we just don't. They're just not on the front page of the paper because they're not Uber who just raised $50 billion and takes 30% of that.
And then some recent sort of hysteria in the market aside, I would also recommend not comparing this token fundraising model directly to what we see in the venture capital context. So the example that I often use is, would Mark Zuckerberg have sold 90% of Facebook in seed round even for $150 million? He would not have, right? And so this is a fundamentally different funding mechanism, and as a result, in comparison with the traditional A, B, C, D round in venture capital isn't necessarily applicable.
Or is that a short-term phenomenon because the supply and demand is so imbalanced right now?
Well, I think people are actually selling. They're getting away with selling less now, right? If you go back in history, Ethereum and other networks sold the majority supply. Now we're starting to see companies sell majority supply and try to bake in additional reserves to use for customer acquisition or for another funding round. So I think the worlds are merging a bit.
Right. You'll see a number of different models, right? So, for example, Kit, right, which is about to do a model, and there's $1 billion company, right? They already have significant value. They have 50 million users, so they're not going to be selling, 80% of their tokens in one go to people, even if it was for say $100 or $200 million. But then in other instances where you require a distributed user base and distributed token holder base, so for example, like a reputation token, that's something where the security achieved through a distribution model is more important than necessarily like the funding mechanism or having multiple rounds or things like that. So you're going to need to sell, say, 80 or 90% of tokens in one go to a distributed user base, and then try to accrue value from there.
I would also add, one thing we tell basically every company we work with in this space is you can't sort of hold everything and try to raise a lot of money because your investors are your lifeblood. This is very public, it's a very open space, and when you start to try and artificially set these high valuations, you just run a much higher risk of degrading your support by sort of impairing your investors. And so structuring can actually kill a great business in this space where you actually want to try and build value alongside your customers and be very prudent about where those starting valuations land, because if the market turns, even if it's not your project, and guys are, these aren't institutional investors. They're not sitting there for 5 years on their hands, hell or high water. They'll run away, grab their lunch money again when only half it's left, and be on to the next thing. So it's extremely important to not be in this space if you're looking to sell a really small share for a lot of money. Sort of something has to give, but in return you have a much better chance of creating that value alongside your
I want to come back to what you said, Jeremy. Is it a short-term phenomenon? So is it, one hypothesis is it's happening because of the appreciation in Bitcoin and Ether, or is Bitcoin and Ether actually appreciating because these tokens are being launched?
So I believe it's a long-term phenomenon. My challenge actually was more on it's less is how like or unlike it'll mimic traditional venture capital, right? And I would put forward a series of arguments that some of the reasons why it's less like traditional venture capital today is the supply-demand balance and some of the learnings from traditional venture in terms of how teams develop, the importance of leadership, scaling your business plan, organizational design are equally prevalent today, right? I mean, the top end of Silicon Valley VC focuses primarily on team development and technology, right? Or a huge amount of their time and effort around that. And I don't see that as being different. And then some of the phenomenons around do one round and you're done is because people are raising very large amounts of money. But when the supply of good projects increases, by definition, that will change that dynamic, right? It will be a delta in the economics. I believe this is a very, very long run phenomenon. Now, the effect back and forth between crypto valuations go up, so people want to diversify their asset bases, then more projects come, and then more fiat capital flows in. Well, that's a network effect, right? That's something we want. That is how the ecosystem grows.
So let's come back to some of the themes we discussed earlier in this panel: governance and collaborative finance. And the stage at which these startups are actually raising money. So these are around Series A, pre-Series A sort of stage.
Way earlier than Series A often.
That's an event. So at that stage, traditionally, we haven't seen retail money going into those companies, not directly. So now retail money is going into pre-Series A company through this vehicle. And we talked about governance, we just touched on that. So how does actually a consumer feel protected investing in this, looking at a white paper and evaluating business model and governance structure, because that's at the core of the trust,
right,
which at PwC we provide to the society. So that's at the core of trust of this new capital market.
So I was with the SCA last week speaking on this topic, and their concern that the person on the panel was voicing to me was much less about securities law and much more about consumer protection, right? And if you advertise you're going to go do something and you take people's money and you don't do it, that's not a securities law violation, that's called fraud, right? And so it's interesting in the evolution of the regulators, the importance of consumer protection in there. So agree, the consumer protection element is a major issue, and it's one that the regulators are discussing.
Right, but I would just add, and it's not necessarily a good or a bad thing, there's not a demand from the consumers to be protected at this point.
But there's a set of laws
right?
that already protect them.
What's that?
There's a set of laws that already protect them.
Right, and there hasn't been any major losses. I mean, we had the Dow Act, right? And that was, you were protected in that sense. But, when we get some kind of fraudulent event where somebody goes to jail, then consumers will demand that protection. But as long as you can buy in a pre-sale or buy in the ICO and get a 4X 30 days later, what protection do I need? I'll take that protection all day long.
I don't think that's how I don't think that's how the regulators see it, though. I think the regulators are the prudential regulation is much more conservative in terms of its concerns around consumer protections than, I think by their definition, you'd be a sophisticated investor. You can take whatever risk you want, right?
My point is that if you look back at all these markets and all these new markets, when the regulators are interested in it, but when does it really reach that tipping point? And it's when it's demand from the consumer for that protection. So to me, that's what it's going to take in this particular case.
So this law or regulation, Enhanced Prudential Standards, EPS, came out with Dodd-Frank. And after the financial crisis, there was a lot of discussion is whether the investment banks actually explain the NBSs properly, or the investors should have actually known that there is inherent risk in those securities, right? So who has the burden to explain, and who has the burden to understand?
So, as Jeremy said, there are laws and there are protocols that govern this already. If I am an issuer of a token, I would simply just follow the same kind of standards and procedures that an issuer of a security would follow. Now, there's going to be some changes that you're not going to be able to do, but in general, follow that type of thing. As an investor, I'm a free markets guy, so I'm happy to just let it be, right? So as an investor, you do have an obligation to research this, and if you're putting it's a risk capital. If you're putting money up, there is risk to that. So you better make sure that you know what you're getting into.
I think you're right, Ryan. the reason I think it hasn't come up yet, and that's going to be the last question, and then I'm going to open it for audience question, is what we have seen is a concentration of token holders within a very small number of. So most of the time, you go to etherscan.io and pull up a token, and you see 5, 6 holders actually control 50% plus, right, or 80%. So that goes to the notion that it's actually the retail investors, so-called retail, is only holding a very tiny portion of the tokens. People who are actually holding the tokens, they have got a diversified portfolio, crypto portfolio most likely. And then they are already appreciated, so they don't really care at this point. Like you bought Bitcoin at $2 and it's trading at 2,600, 2,700. So you have a long way to go before you're actually gonna go, file a lawsuit or something. So that leads me to the last question, Alex. How should the issuers and the investors should look at the structure? You touched on the structure a little bit, so that at the end of the ICO there's not a significant concentration, or if it is, that's a desirable effect.
Yeah, so how we think about that is something called like decentralization metrics, right? And that might be, historically, if you look back at all the projects, you say, they raised, the Ethereum rate had 10,000 investors that all put in, a couple $1,000, and you sort of look at that over time. So, like, there's been some recent examples of, maybe we'll walk through the history here a bit, but, first the space kind of started like a Kickstarter where you're almost sending money to a forum who had put out a white paper to an address, and it was a donation. You were extremely excited about what they were working on, and you were willing to part with a little bit of money for it. Then we started to see a little bit more, not institutionalization, but a little bit more structure around how best practices might be done, and that was you wrote a white paper, you sort of go on some of these forums, you talk to people, and then we started to see a little more interest building in the space, and people would try and create incentives to gamify the investment opportunity, where you create some FOMO around have an hour where you get a 50% bonus on what you buy, and then it sort of declines thereafter. And then we started to reach a point where sales started selling out in that first hour, and so what happened after that was people just started raising the amount they were raising, and they kept selling out. So here we are, kind of 3 years later, and what we're seeing is actually the inverse a bit, where people want to get back to getting that widespread, diversified user base for $5,000 across 20,000 people, because that really kickstarts kind of the chicken and egg problem for a lot of these networks. But it's very hard to do that now, because there are guys that have basically said, a couple months ago, I started seeing exchanges buying chunks. And why exchanges started buying chunks was that they could create their own internal IOU markets. And like Brian said, this is a free market, right? It's these things are transferable once they're out there, or if they're not, then you're an exchange, and perfectly, you can go in and create an IOU market for a token that you hold, but you can't give to your customers yet. And then, what that started was, okay, everyone's kind of like, okay, how are we going to keep exchanges? How are we going to keep large, sort of financial buyers out of here? But what you see is like a free market where anyone can be Goldman Sachs. It's like, if I block this entire supply, I become the intermediary. And when you become the intermediary, then you're like the IPO issuer, where you're like, okay, well, I'm going to take a nice cut of this middle by having blocked the sale. So now you see guys that understand the kind of Ethereum microstructure really well, that are basically able to break any dynamic cap ceilings, limits that people are putting in place. And I really don't see. I have a lot of ways that maybe make things actually make it better. There's guys like Herbit and other people who do sort of invitation codes to long-term supporters to try and actually get the decentralization metric before you go out with the public sale, and then you let sort of the frenzy happen. But at the end of the day, I think something that the ConsenSys guys are working on with identity is the only way to eventually control how many wallet addresses you have hitting the ground.
So I think we're in agreement that the original sort of first come first serve model of these token crowd funds has been taken to its extreme and is essentially broken. Right, what we're seeing in the last week is, in the last couple of weeks, is the breakdown of this model. So then, and why is that? In part, it's because the number of, say, wealthy or high net worth individuals in this space is actually quite significant, quite distributed, right? Bitcoin and this is really amazing. Bitcoin and Ethereum have spawned roughly 10,000 millionaires in the last 5 years. Now that's more than the millionaires that have been spawned in Silicon Valley in the last 5 years. So it's a really remarkable phenomenon. The flip side of that is now you have 10,000 people who all consider themselves highly sophisticated investors who are professional venture capitalists. Right? So then all these people are sort of flooding into these markets because they consider themselves professional smart money, and that's great. But you're having a breakdown of the system as a result. And so what I find myself proposing to a lot of our high potential projects today who are coming to us and experiencing quite a bit of frustration with the amount of professional investors or VCs approaching them, trying to throw as much money as possible at them, is to require I propose an RFP process whereby you make a commercial and non-commercial component of your proposal. If you're a VC that contends that you are here to add value and contribute to the project and do something that they can't do by themselves, along with giving them money, then you should have some deliverables that you can execute on. And in order to get your full allotment of tokens, you need to execute on those non-commercial deliverables along with giving them money. And then that's also just going to help these projects a lot more than just straight money, and also help with a bit of a filtration process, because not all these 10,000 newly minted millionaires can actually help in non-commercial ways. And so we're starting to sort of play around with how do we get to filtration such that you have the best group of investors and not just the first group of investors.
15 seconds, Jeremy.
And that's kind of a bouncy program too.
Yeah. 15 seconds.